Silver collapsed 8% in a single session. Gold, the most stable asset on Earth, down 3.5%. This was not a correction. This was a liquidation event. When precious metals crash together, when institutions sell their best assets, when the safe havens themselves become the casualties, the financial system is not adjusting. It is screaming. And what happened in the silver market is not the crisis. It is the warning. Welcome to Financial Revelations. If you have been in business long enough, if you have seen markets rise and fall, if you understand that wisdom comes from watching patterns repeat across decades, then you know this channel is built for serious minds. Do us a favor, take a moment and subscribe. Not because we ask lightly, but because the analysis you are about to hear does not appear on mainstream financial networks. And while you are here, leave a comment. Tell us where you're watching from. New York, London, Mumbai, Sao Paulo. We want to know where the serious money is paying attention. Now, let us dissect what really happened when they smashed silver. The trading screens turned red. Not the gentle red of a normal down day, but the deep, violent red that makes veteran traders stop mid-sentence and stare. Silver had collapsed. In a single trading session, the price dropped from $79.25 to $72.75. $6.50 gone. That is an 8% decline in hours. For those who understand commodity markets, 8% is not a correction. It is a demolition. But silver was not alone. Gold, the asset that central banks hoard, the metal that has survived empires and outlasted currencies, fell alongside it. Gold dropped $156, from $4,534 to $4,378. A 3.5% crash. When silver falls, traders notice. When gold falls with it, economists pay attention. When both crash together with this kind of violence, something deeper is breaking. This was not about sentiment. It was not about bearish forecasts or negative news headlines. This was about survival. The observer watching this unfold must understand a critical distinction. Markets fall for two reasons. The first reason is choice. Investors sell because they believe prices will go lower. They sell because they think the asset is overvalued. The second reason is force. They sell because they have no other option. What happened in the silver market was not choice. It was force. Institutions were not selling silver because they suddenly hated the metal. They were selling silver because it was the only liquid asset they had left to meet their obligations. This is the anatomy of a liquidity crisis. When financial institutions face margin calls, when their leveraged positions move against them, when the algorithm sends the notice that more collateral is required immediately, they do not have time to think. They do not have time to wait for better prices. They sell what they can, not what they want. And in the precious metals market, silver is always the first to go. The mechanics are brutal in their simplicity. A fund holds positions across multiple markets: equities, bonds, commodities, real estate. Those positions are built on borrowed money, on leverage that amplifies both gains and losses. When prices move against them, the broker demands more cash. Not tomorrow, not next week, immediately. The fund looks at its portfolio. Real estate cannot be sold in an hour. Bonds might take days to liquidate at reasonable prices. Equities are possible. But if the stock market is also falling, selling there means locking in massive losses. But silver trades 24 hours a day. Silver has deep markets with constant liquidity. Silver can be sold right now, in size, without waiting. So they sell silver. And when one fund sells, it pushes the price down. When the price drops, it triggers margin calls at other funds who also hold silver. Those funds must also sell. The price drops further. More margin calls, more forced selling. This is not a market. It is a cascade. The observer must recognize what this reveals about the financial system. Precious metals are supposed to be safe havens. They are the assets investors run to when everything else is falling apart. Gold and silver rise during uncertainty, during inflation, during crisis. That is the historical pattern. But when gold and silver crash together, when they fall with the kind of speed and violence seen in this session, the system is not experiencing normal stress. It is experiencing a liquidity emergency. Cash has become more valuable than assets. Survival has become more important than strategy. The institutions are not thinking about next quarter. They are thinking about the next hour. And that is the signal. The crash in silver was not an isolated event. It was a symptom. The price on the screen, $72.75, down 8%. That number tells a story. But the real story is not about silver. The real story is about what happens when the machines that run the financial system start breaking down, when leverage unwinds, when forced selling begins, when liquidity dries up. The crash in one market is never just about that market. It is the first domino. And the observer who understands this, who sees beyond the red numbers on the screen, who recognizes the pattern, that observer knows what is coming next. Because when precious metals fall like this, the margin calls are just beginning. There's a phone call that every trader fears. It comes without warning. The voice on the other end is calm, professional, but the message is absolute. You need to post additional margin by market close, or we liquidate your positions. No negotiation, no extensions, no second chances. This is the margin call. And when it happens to one fund, it rarely stays contained. The mechanics of a margin cascade are simple in theory, but devastating in execution. A fund enters the commodities market with confidence. They buy silver futures contracts, not with their own money, but with borrowed capital. For every dollar they put down, they control 10, 20, sometimes $50 worth of silver. This is leverage. When prices rise, their profits multiply. But when prices fall, their losses multiply just as fast. And there's a line, a specific price point, where the broker says enough. That line is called the maintenance margin. When silver's price drops below that threshold, the fund receives the call. They must deposit more cash immediately, or the broker will sell their positions at whatever price the market will pay. Now imagine this is not happening to one fund. Imagine it is happening to dozens. The first fund sells silver to meet their margin call. The price drops. That price drop pushes a second fund below their maintenance margin. They receive the call. They must sell. Their selling pushes the price lower. A third fund, who was perfectly fine 10 minutes ago, suddenly finds themselves underwater. Another margin call. More forced selling. The price accelerates downward. This is not a market-finding equilibrium. This is a cascade, a chain reaction where each failure creates the next. The observer must understand why precious metals are uniquely vulnerable to this phenomenon. In the equity markets, there are circuit breakers, trading halts that pause activity when volatility spikes. In the bond markets, central banks can intervene. They can buy assets to stabilize prices. But in the commodities, futures markets, especially in silver, the market never stops. It trades through London, through New York, through Asia, 24 hours, 7 days a week. There are no timeouts. There are no pauses to catch your breath. When the cascade begins, it runs until every overleveraged position has been liquidated. But the cascade does not respect boundaries. A fund facing a margin call in silver does not only hold silver, they hold gold, copper, oil, perhaps equities and bonds as well. When they must raise cash, they look across their entire portfolio. What can be sold quickly? What has liquidity? Gold becomes a target, not because gold is weak, but because gold can be converted to cash. So they sell gold too. Now the gold market is falling. Other funds holding gold see their positions deteriorate. More margin calls, more selling. The cascade spreads. This is where algorithms enter the story. Modern trading is not dominated by humans making careful decisions. It is dominated by machines executing programmed instructions. When an algorithm detects falling prices, it does not ask why. It does not consider context or historical patterns. It follows its risk management protocol. Sell, reduce exposure, exit the position. Thousands of algorithms, all programmed with similar logic, all reacting to the same price signals. They sell simultaneously. The volume overwhelms the market. Bid prices collapse because there are too many sellers and not enough buyers. The machines do not panic, but the effect is the same as panic. Prices fall faster than any human trader could execute. The historical record shows this pattern repeating. In 2008, when Lehman Brothers collapsed, commodities crashed together. Oil, copper, silver, gold, all fell in unison. Not because the fundamentals changed overnight, but because funds needed cash. They sold everything liquid. In March of 2020, when COVID lockdowns began, the same pattern emerged. Even gold, the ultimate safe haven, dropped sharply. Why? Margin calls, liquidity crisis, forced selling. The pattern is consistent. When the financial system experiences stress, when leverage unwinds, when institutions must choose between selling assets or defaulting on obligations, they sell. And the most liquid markets suffer the most violent crashes. The observer, watching silver fall 8% in a single session, is not witnessing an isolated event. They are witnessing the first stage of a cascade. Somewhere in the system, a fund has failed. Their positions are being liquidated. Their selling is creating pressure on other funds. Those funds are now making impossible choices. Do they hold and hope the price recovers? Or do they sell now, accept the losses, and preserve capital for another day? Most choose survival. They sell. And with each sale, the cascade accelerates. The margin call that destroyed silver was not one phone call. It was hundreds, perhaps thousands, each one triggering the next, each one pushing prices lower, each one revealing just how fragile the system becomes when leverage meets reality. And the most terrifying part? This is only the beginning, because when precious metals cascade, when forced selling spreads across asset classes, the real question is not what has already fallen. The question is what falls next. There is a moment in every crisis when the unthinkable becomes visible, when the asset that should rise falls, when the shelter that should protect collapses, when the last safe place is no longer safe. Gold dropped $156 in a single session. And for those who understand what gold represents in the architecture of global finance, that drop was not just a price movement, it was a distress signal. Gold does not behave like other assets. When stock markets crash, gold rises. When currencies weaken, gold strengthens. When inflation accelerates, investors flee to gold. This is not theory, this is pattern. Repeated across centuries, gold is the final refuge. It is the asset that holds value when everything else is questioned. Central banks hoard it, governments stockpile it, billionaires hide it in vaults. So when gold falls sharply, when it crashes alongside silver, when it loses 3.5% in hours, something fundamental has broken. The observer must ask a critical question. Why would anyone sell gold during a crisis? The answer reveals the true nature of what is happening. They are not selling gold because they want to. They are selling gold because it is the only asset valuable enough, liquid enough, trusted enough, to raise the cash they desperately need. This is the principle of selling your best asset first. In normal times, in strategic downturns, institutions sell their weakest holdings. They dump the speculative positions. They exit the risky bets. They keep their core, their best, their safest assets. But when the margin calls arrive in waves, when the collateral requirements exceed available cash, when survival is measured in hours, not months, strategy disappears. They sell what works. They sell what buyers will actually purchase. They sell gold. And this creates a paradox that terrifies financial professionals. If gold is falling, if the ultimate safe haven is being liquidated, where is the money going? The answer is nowhere. It is not going into stocks. Those are falling too. It is not going into real estate. That market is frozen. It is not rotating into bonds because bond markets are showing their own signs of stress. The money is disappearing. It is being used to pay debts, to meet margin requirements, to cover losses, to prevent default. This is not a rotation. This is a liquidation. Cash is not moving from one investment to another. Cash is evaporating from the system entirely. The Treasury market holds the key to understanding this. United States Treasury bonds are considered the safest asset in the world. Safer than gold, safer than any corporate bond, safer than any equity. And when investors fear crisis, they buy treasuries. The price of treasuries rises, and yields fall. This is the classic flight to safety, but look closer at what happened during the silver crash. Treasury yields did not fall as expected. In fact, in some maturities, yields rose. This means treasury prices fell. Even treasuries, even the safest government bonds on earth, were being sold. Not because they are unsafe, but because institutions needed cash more than they needed safety. This pattern has a name in financial history. It is called a liquidity freeze. It is the moment when markets stop functioning as markets, when buyers vanish, when prices become meaningless because no one is willing to transact, when the only thing that matters is immediate, spendable cash. The Federal Reserve understands this pattern. They have studied 2008. They have studied 2020. They know that when gold falls with silver, when treasuries show stress, when liquidity evaporates, the system is approaching a breaking point. And yet, the Federal Reserve is constrained. Interest rates are already at levels that were unthinkable a few years ago. Inflation remains a concern. Printing money, flooding the system with liquidity, carries its own dangers. So they watch, they calculate. They wait for the moment when intervention becomes unavoidable. But that moment has not arrived yet. And in the space between crisis and intervention, markets fall. The dollar tells another part of this story. When global markets panic, when uncertainty spikes, the United States dollar typically strengthens. Investors around the world sell their local assets and buy dollars. This is the dollar's role as the global reserve currency. But examine the currency markets during this precious metals crash. The dollar's movement was erratic, unstable, lacking the conviction of a true safe haven rally. Why? Because even the dollar, even the world's reserve currency, is caught in the contradiction. If the Federal Reserve intervenes to provide liquidity, the dollar weakens. If they do not intervene, the crisis deepens. The currency markets are paralyzed by this impossible choice. And that paralysis, that uncertainty about the dollar itself, that is perhaps the most dangerous signal of all. The business leader watching this unfold must understand the implications. This is not about gold and silver prices. This is about the plumbing of the financial system. When liquidity dries up, when institutions must sell their best assets, when even safe havens become casualties. The contagion spreads, credit markets tighten, banks become reluctant to lend, business expansion plans are delayed, payrolls come under scrutiny, supply chains feel the pressure as financing becomes scarce. The crash in precious metals is not the crisis. It is the early warning system. Gold at $4,378, down $156. That number on the screen is not just a commodity price. It is a measurement of system stress. It is a gauge of liquidity pressure. It is a signal that somewhere deep in the financial architecture, the foundations are cracking. And the observer who recognizes this signal, who understands what gold's collapse truly means, that observer knows the next question is not if intervention will come. The question is whether it will come in time. History does not repeat itself exactly, but it rhymes. And when precious metals crash together, when liquidity vanishes, when forced selling creates cascades, the pattern has played out before. The question is not whether recovery will come. The question is what kind of recovery, how long it takes, and what the world looks like on the other side. September of 2008. Lehman Brothers collapsed. The global financial system seized. Credit markets froze, and commodities, including gold and silver, fell sharply. Silver dropped from $20 to under $9 in a matter of weeks. Gold fell from $1,000 to $750. The safe havens were not safe. Why? Because hedge funds, pension funds, investment banks all faced the same problem. Margin calls. They needed cash immediately. They sold everything they could. The most liquid assets fell the hardest. But then something happened. The Federal Reserve intervened. They cut interest rates to near zero. They launched quantitative easing, buying trillions of dollars worth of bonds. They flooded the system with liquidity, and precious metals responded. By 2011, silver reached $48. Gold climbed to $1,900. The recovery was not just complete, it was explosive. But 2008 taught a deeper lesson. The recovery did not happen immediately. There was a period, weeks, sometimes months, where prices stayed depressed, where investors who bought too early watched their positions bleed further, where patience was tested, and many failed the test. The institutions that survived were not the ones who predicted the bottom perfectly. They were the ones who understood the mechanism. They knew that when central banks intervene with massive liquidity, when cash floods back into the system, that cash must go somewhere. And historically, it flows into hard assets, into gold, into silver, into anything that cannot be printed. March of 2020. COVID lockdowns began. Markets crashed globally. Stocks fell 30% in weeks. And gold, despite being a safe haven, dropped from $1,700 to $1,500. Silver collapsed from $18 to $12. The pattern repeated. Liquidity crisis, forced selling, precious metals falling alongside everything else. But this time, the intervention came faster. The Federal Reserve acted within days. Emergency rate cuts, unlimited quantitative easing, direct loans to corporations. The phrase, whatever it takes, became policy. And the recovery in precious metals was stunning. By August of 2020, gold reached $2,070. Silver hit $29. The crash to recovery cycle took less than 6 months. The observer comparing these two historical precedents must notice the critical variable, speed of intervention. In 2008, central banks hesitated, they debated, they calculated, they worried about moral hazard. The recovery took years. In 2020, central banks acted immediately, they abandoned hesitation. The recovery took months. This pattern reveals something important about modern financial systems. Central banks have learned. They know that liquidity crises, if left unchecked, create depressions. They know that waiting too long turns a crash into a collapse. So the question for the current situation becomes obvious. Will the Federal Reserve intervene? And if so, when? But history also teaches a warning. Not every crash ends in recovery. Not every intervention works. The 1930s depression began with a stock market crash. Central banks at that time did not have the tools or the understanding to respond effectively. They allowed banks to fail. They allowed the money supply to contract. They turned a recession into a decade-long catastrophe. Precious metals during that period did rise, because governments devalued currencies and abandoned the gold standard. But the broader economy suffered devastation. Jobs disappeared. Businesses closed. Wealth evaporated. So the pattern is not automatic. Recovery requires action. It requires central banks to recognize the crisis. It requires governments to support the intervention. It requires the political will to accept the consequences, including potential inflation, including massive debt. The current situation sits at a crossroads. Silver at $72.75, gold at $4,378. Both down sharply, both showing signs of forced liquidation. The Federal Reserve is watching. They see the same charts. They recognize the same patterns. But they also face constraints that did not exist in 2008 or 2020. Inflation is still elevated. Government debt is at historic levels. Public tolerance for bailouts has diminished. The political environment is more complex. So intervention, if it comes, may be delayed, or it may be smaller in scale. Or it may come with conditions that change the recovery trajectory. For the business leader, for the entrepreneur, for the investor, the lesson from history is not to predict the exact bottom. The lesson is to understand the mechanism. Liquidity crises end when cash returns to the system. Cash returns when central banks act. Central banks act when the pain becomes systemic, when major institutions face failure, when the political cost of inaction exceeds the political cost of intervention. That moment has not arrived yet, but it is approaching. The signals are visible, precious metals crashing together, treasury markets showing stress, credit spreads widening. These are not random movements. They are symptoms of a system under pressure. The timeline matters. In 2008, the Federal Reserve waited months before massive intervention. Prices fell further during that waiting period. In 2020, intervention came within weeks. The crash was shorter but more violent. For the current crisis, the timeline remains unknown, but the variables to watch are clear. Are major financial institutions showing signs of failure? Are credit markets seizing up? Are stock markets entering sustained decline? When these signals intensify, intervention becomes inevitable. Silver at $72.75 is not the end of the story. It is a chapter, a painful chapter, a chapter written in forced selling and margin calls. But history suggests chapters like this eventually turn, not because markets are fair, not because justice prevails, but because central banks, for better or worse, will not allow the system to collapse entirely. They will act. The question is when. And for those who understand the pattern, who study the precedents, who recognize the signals, that question is the only one that matters. Because on the other side of intervention, on the other side of the liquidity flood, precious metals have historically surged, not immediately, not predictably, but consistently. The observer who understands this does not panic during the crash. They prepare for what follows. They position for the recovery that history suggests will come. They wait, with patience, with discipline, with knowledge, for the moment when the Federal Reserve finally acts. And when that moment arrives, the cascade reverses.